Hey, I'm Eugene. For those who don't know me, I'm doing middle term investment, and now I'm on my way to complete the third step of my initial plan, which is to buy long of shortlisted stocks on US and EU markets. I say it's third step specifically just to get your attention, and now you will think what was the first one. So first step was a correction which was visible in November 2019 for a lot of people on the market, and that's why I sold out a lot of stocks in December, January 20. Second, I hold majority of my cash in USD in 3 different accounts. As we know, there might be some issues like we have seen a couple of days ago, weeks ago in Robinhood and similar. Third, I'm trying to place my bids to enter the market. I do fast deals nowadays when I see a market opportunity closer to the day trading, but this is out of this explanation below. Further, what you will see is not a prediction. It's a personal opinion, not a call for action or an investment advice. If you share some stuff, great, I'm happy, but you have to do your homework as well and take 100% personal decision to buy and sell. One of the main reasons to shot this video is to show one of the ways how I analyze the market and set a scenario or scenarios, or you can call it a plan, and then further execute it. No point to show the first steps, but the third one is ongoing right now, so it should be very interesting for you if you are willing to buy stocks and keep it for a mid-term investment like I do. Well, we all know huge Wall Street names like JP Morgan, Goldman, and in a period of 2-3 months, they changed their outlook for S&P just almost twice. They started with 3,700 somewhere in the middle of January, then it's 2,000 when the crash started, and just a couple of days ago it's back to 3,000. So it's really a roller coaster that they are showing you here. And for me, as for the retail investor, I understand I won't find any truth there. So markets are forward looking, so what you read there is basically already pre-chewed information that was played and priced in. Anyway, we'll get back to that. Simply speaking, what I'm trying to say, build your own logic and scenarios based on the market mechanics you personally understand and you can put together, and not on the news that you read. Of course, this type of news are perfect eye-catching traffic to get more revenues from the ads campaign distributed inside those news. Here's the thing. So let's go to the chart, and you see S&P 500 index with 1 monthly time frame. Blue dotted lines are showing you the actual range where the price is working. So it was formed in 2009. Why it's a range? Because every time you see the price was trying to go below this level, it got a good support. On the other side, every time the price was trying to go above that level, it actually formed a move back. Situation has changed at this point. Let's put it 1. So the price went significantly above and formed a new channel, a new reality on the market in the end of 2017, something like that. And as of that moment, in fact, you see that the price was actually in this range all the time, with some tests of the line above and on the line of the line below. Why it has happened? Well, there could be many questions and many answers, but in reality, it means that the market was saying, actually right now we have a better economy, we have better companies, more revenues, more earnings per share, and so on and so on. Then important point happened over here. See that the price in the end of 2019 was trying actually to go even beyond that new level which was formed around 2 years ago, and for a couple of months it stayed there. So when I'm saying that actually I started to sell, I saw this situation, and for me, without any indicators of anything else, you see that in the long term, in mid-term, it makes no sense to hold the stocks. It's better to sell. That's why I sold some of my stocks, let's say 80%, during this period of time. And then the situation happened. You see third point over here, we broke the support line. You see fourth point over here, just almost simultaneously with one candle it broke another support, and we actually moved to this area. In this area, this is a support which was formed back in 2014 and 15. Remember this point when the price was holding on the resistance for a long time, and then after it actually broke it a couple of years later. So right now, let's go on the shorter time frame where I can show you what we can have in the future. Okay, so we are on a daily time frame for the S&P 500, and you see the same lines, same blue lines. I also put the ranges that I mentioned in the previous slide. So it's a range 2017-2020, the one which was created by the higher expectations from the economy. Then the previous range 2009-2017 over here. This one is actually plus 8%, around like that. And below you see the support zone, which was a bouncer for all the corrections back in time up to 2009. So, and the very, very low support level. Now, let's go to the point number one over here. You clearly see that we are in a zone which is above the range which was created for me based on the hype. Then the second point is the really all-time high area. So that's the maximum. I think it was 3,393, something like that. And then the situation started. So you see that the price, based on the news and all this kind of situations that we see with the pandemic, went down to the point number 3 over here, and it actually sliced the whole range. It actually got a good support at this point over here, and then it went on the upper part of the range, the point number 4. And then you have the OPEC deal. Something happened over here. So Russians came and said that, okay, we don't want to decrease the amount of oil we produce, and then the situation started, which has formed a classical dead cat. And then we are in the point number 5, where actually you see the whole range from 2009 and 2017 first time was sliced, and here it was broken significantly, not a small break, but really a huge deep cut. And then it was stopped nearly about the support level from 2009. So then we see the recovery, the point number, the green line, not yet the point number 6. It actually came into the bottom of the range at this point. It got rejected, but it got a very good support. What is important is that you see those gaps over here, which is not very good, but I will not explain why over here. So, and now it's in the middle of the range from 2009-2017. So now it's a question over here. Is this price over here is fair or not? So to my opinion, it is not, and here is why. What is the fair value? It's clear to me that the stock market was overheated since 2017-18, and especially at the beginning of 2020, right? So healthy correction was needed to calm the temperature down. Usually it's 10-15% down and V or W-shaped recovery. That gives us an overall figure around 2,850 from the all-time highs. Fix it right now. We are around the fair value right now, 2,800, not far from this target. And it's almost in the middle of the initially formed range since 2009. If you were in 2020, January, I would say it's a very fair value, maybe even a bit more conservative. But it would have been fair value before pandemic story, before the oil crisis we see now, before the economies were hit hard all over the places in the world, and people were locked at home for more than a month. You can say, what you're talking about, maybe all of those points were already priced in. I don't really think so. To assess it all, you need a lot of data and you need to model correlations between those data sources correctly. And only after you can forecast some scenarios and impact. These models were never made before under such circumstances. And nobody has a sufficient amount of data to do that. No doubt we're gonna see hit in a real economy. By the way, Bill Gates shares my thoughts. Here, no one should think the government can wave a wand and all of a sudden the economy is anything like it was before this happened. Let's try to make a hypothesis. Just have a look at the first symptoms in the US. Car sales dropped 33% in March 2020 and April is not going to be sexy as well. Retail and food services sales in US dropped 8.7 in March. Unemployment is 22 million. Just for the records, 22 million is actually more than what US economy generated since 2009. And in 1 month, I'm not going to be surprised if I see 35 or even 40 million unemployed. In order to mitigate that, governments made fast moves, which were good steps to prevent economies from collapse, but actions were not clean and I would even say sometimes dirty. Can't really count now, is it 5 or is it $6 trillion stimulus from Fed? Recently, first time in history, Fed is buying junk bonds, really junk bonds. Answer a simple question. Would you buy some rotten potatoes on the market for the dinner with your family? I guess the answer is no. But that's what Fed is actually doing. They are buying junk bonds. They also somehow solved the OPEC Plus deal, but the real problem is not yet solved. Prices just dropped from $28 to $17 today. In the course of a week, we thought $20 was a bottom, but hello, we have a second bottom. If you want me to make a dedicated video about OPEC Plus deal, just also comment that in the comment section. As you understood, I don't know the impact either, but I assume that the market should settle from its current levels within the zone of 2,500 to 2,600. After, volatility will be down and majority of the obstacles are solved. Then, if everything is optimistic, we should slowly grow to 3,000 around this fall, just before the US presidential elections in America. Trump will do everything to make it happen. Otherwise, chances to be re-elected are melting like hell. Why 2,500, 2,600? Remember the market made range 2 that I showed 10 minutes ago? It was plus 8% from range 1 when everything was shining and investors were bullish buying Tesla for 950 USD per share. So, taking all those symptoms, I think we should go at least one range down from historical range 1 and slash expectations to around 10%. That's actually an optimistic move. From 2,800, it gives us a fair settled market price around 2,500, 600. However, short-term markets are inefficient with such volatility and I expect another swing of a pendulum, potentially to the lows we've seen or maybe even lower, depending how bad situation in the real economy would be. And that should be a good moment to load around 50% of my cash. You decide for yourself. Right now, I keep cash because what happens on the market is perfectly shown in the picture here. The real economy is suffering, but the stocks are growing like mushrooms after the rain thanks to Fed guys. And when I read the comments of Trump, economy will skyrocket once the pandemic is over, I see picture like this. The driver is drunk, no spare tires, engine is 3/4 broken, but we should skyrocket. I don't really take that. In a nutshell, short term, there is one dilemma to be solved. Governments are trying to open the economy so that unemployment is gonna get better. They don't have to print more money to support people and companies and so on and so forth. Planes will start to fly and oil will come back to its normal demand cycle, which we don't see at all right now. But With opening, they must not forget that we don't have proper medicine and vaccine. So we could see another second or third surge of the cases, and they will have to lock down those parts of or areas in the countries. This is what we see right now in China in some small areas. What's next? Seasons of report. It's actually ongoing right now. We see first results, and you see the list right now where you see the other companies that are going to report. What I'm really waiting for is the real data that will come on 14th, 15th of May, where we will be able to see what institutionals did in Q1 2020. I will make another video about that. Don't forget to smash the like button, and thanks for watching. See you.